It's time now for the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Today is our second installment on insurance, but we're going to be more specific about how insurance affects your wealth and your assets. We talked last week about how to handle a claim, what really goes on behind the scenes, and it was a lot of real practical knowledge of what many of you don't realize till you're in the middle of a claim. But our belief statement here at Gem Young Insurance and Wealth Advisors is we're a family business that does business with individuals and families that help people protect their wealth and their assets. So many of you know us for just the wealth part of it, but protecting your assets is just as important, because if we don't do a good job on that, we could wreck the job we're doing on the wealth side, right? A key component to a strong financial plan is the right type and right amount of life insurance. We've talked about this a little bit in the past, but we want to talk today about how this integrates with your financial plan, why it's important, and some do's and don'ts. I think that's the key part. So this isn't, like I said to you last week, this isn't a series on raw for products. This is about rubber meets the road conversations on where these products are appropriate for you with your plan, and most importantly, when they're not appropriate. I know the life insurance business for a long time had the stigma of high-pressure salespeople forcing people or persuading people too strongly to buy products, and it's left a negative impact on a lot of you. But it's a valuable financial planning tool. The key is, like everything else we do, it's making sure that you have the right professionals and making sure that you own the right product the right way, and you're paying what is reasonable for what the goals is you're trying to accomplish. See, I grew up in an insurance house, but I also was a financial planning guy from the get-go. So insurance to me always had to make sense. It wasn't ever an emotional conversation for me. And if it didn't make sense, it didn't make sense. But we're going to try to dig through and sift through all of that today in this podcast. So I have with me Stephen Daprile, the president of Gem Young Wealth Advisors. Hello, Stephen.
Hey there. Thanks for having me.
And then I got Sammy Morocco back in the house. He's a retired income certified specialist. Hello, Sammy.
Hello, Leo. How are you?
Good. I got to say this, Stevie, every time I have him on. Sammy's back in the house.
Yes. Yeah.
Sammy,
At least I'm wearing a good shirt for you to look
Oh,
at.
I'm so glad you're not wearing a Steelers shirt. Gosh.
Much better.
Right.
Much better.
Yeah, my eyes bleed, Steven, every time he comes in with a Steelers shirt. I
Yeah.
know I just offended half the audience by saying
It's
that.
brutal. Honestly, my eyes bleed when I look at a Browns shirt too. So,
We just love to be dysfunctional.
yeah,
That's what it is.
100%.
Yeah. So that's kind of the landscape, boys, of what I want to talk about today. And Steve, I'm going to start with you just from a purely strategic point of view, because we deal with clients at different life stages, right? And one of the things I used to say in my career was life insurance is always needed, but the reason you own it changes. So you have to make sure, like everything else we do in the financial planning business, the insurance business, and we talked about this last week, and we're going to hammer the point home over the next 2 weeks. The problem I see with most people with their insurance policies is they get stagnant. They don't look at them. They don't review them. They just pay premiums. And then in some cases, they start to complain that it's getting to be too high. They don't really know why. So I'm challenging listeners to be proactive in their insurance portfolio for their own health and wellness, their own financial health and wellness, and the financial health and wellness of the family. For instance, life insurance, I've seen situations where they have too much later on in life, and in many cases, not enough. Because we don't necessarily look at our insurance progressively in terms of how we continue to grow and expand, and where it's needed, where it's not needed, right? Mm-hmm. So, and we find the types of products that people own change. They need to change on what they own and how they own it. And a lot of people aren't aware of that. And I know it's not an exciting, crazy, fun conversation for people to have, but from where we sit as insurance professionals and financial planners, it's vital that we get this piece right. You know, for instance, Stephen, in a younger case scenario, what's the purpose of life insurance for a young family? What are they trying to accomplish?
Yeah, income replacement, right? Debt protection, legacy planning, maybe less so on that last one. But it serves a vital purpose. You know, you have a young family with kids and a spouse. If a primary or even oftentimes a secondary breadwinner passes away, it can be financially devastating. And ensuring that you've done your homework on should that occasion arise, can you've transferred that risk, right? It's something that is important for people to consider, and it's important for them to recognize, you know, why they have it. I think a lot of people who have it don't even know. Maybe they did know, but they've forgotten why they have it. So,
And for us, with our financial planning software, we can actually make that more mathematical.
right, yeah. And I'm a math. I guess I'm a math guy. I'm certainly. What are the tangible risks? I'm a visualization guy, right? If you're one of those people who would like to visualize it, you know, how does this affect me if something were to happen, right? What does it take to negate that or reduce that risk or reduce that impact on my family, and am I comfortable with what I need to do that? It makes it so much more of a needs-based discussion and a risk-based discussion rather than a sale. You know what I mean?
Right. So I'm going to build off that, but I'm going to throw it back at you, Sammy. I've always said this. I know that we started out talking about life insurance, but I want to shift because, you know, there's frequency, severity, those are terms we use in the insurance business, right? Then there's rareness of a severity, but fear that goes with it. That's why we carry higher liability limits. In the event we kill somebody in a car accident, you know, we want to make sure we have sufficient insurance that if we get sued, that we protect our personal assets. That's part of protecting wealth and assets, right? But I think a product that doesn't get enough conversation, and Steve, I think you'll shake your head yes at this, and something I want to bring into this conversation is disability insurance. And the reason I want to talk about that as much as life insurance is if you look at statistics, your probability of becoming disabled is during your working years is much greater than you dying during your working years. And it's a product many times when we talk to people about that, they're like, yeah, I have life insurance, but I don't have disability insurance, right? And Sam, from your point of view, give me some examples of where this plays out with your clients, because I think it should be just as much part of the conversation as life insurance.
Well, you mentioned a probability of disability. I'm studying some Social Security classes, and it says 25% of guys or men in their 20s will have a probability of having something or a disability happen in their life. And that statistic has gone up since, you know, you and I started in the insurance business. It was never looked at. The professionals always looked at disability. You know, the doctors, lawyers, attorneys, they looked at disability because their income was high. And if they had a disability, even a partial disability, sometimes they didn't get paid, and they were concerned about it.
Take a surgeon, for instance.
Right, a surgeon who operated, saw people in his office, but also went into the operating room to do surgery. Well, he actually has two jobs, as a doctor calling on clients and as a surgeon. Well, if he busted a finger and he couldn't do surgery, he still could see patients, but his income would go away.
And if you didn't do surgery, you couldn't see patients because there's no patients to see because you didn't do
right.
surgery. So it's a cascading scenario.
Correct. Well, and part of his income would be gone. Let's for instance, if he was a OBGYN, he can still consult with female patients coming in. He may not be able to do surgery. He still would have income from that, but he would lose his surgical income.
Right.
So he would have to make sure that he was covered. But, you know, take a teacher or take a truck driver or take a landscaping person, you know, take what we used to call three levels, 3A, 2A, 1A categorize of occupations in the disability business. They needed it too. And so in our planning has to bring in disability if a person has the need and the risk for disability. And I stress need or risk. because disability is not something you go out and you hand out, here, get this, get your disability here. That's not bland. It has to be specialized to that person's income, their resources, and the financial situation that they're in. Just like anything else that we do, it has to fit. I'm a size 12. All right. My wife will never be able to wear my shoes. She takes a 6. So why am I going to try to do that? It doesn't fit. So one size doesn't fit all.
So back in the day, the disability business was catering to white collar.
Yes.
And even though the blue collar ranks needed it, their opportunities weren't very good. Benefits weren't very good. In many cases, what insurance companies were charging from the world I came from, I looked at the premiums charged versus the benefits they're able to get. And in so many cases, it didn't make sense. Has that evolved at all, Sam?
Yes. It has gotten much better over the years. Usually, if you were the rating system, okay, as a to high school basketball, they have Class A, AA, AAA. So in disability, you've got 6A, which is a professional, 5As were professionals. And then you've got 4As, 3As, 2As, and then 1A. So if you take from the 3A down to the 1A, they normally had benefits that would be shorter, 2 years, 5 years. That's it. You usually have to have restrictions on the definition of disability, okay, and the ease of qualifying for it. Well, over the years, they've gotten better. One of the reasons why is that early years, the disability insurance companies were afraid of taking that risk because they assumed, if I owned my own contracting company and I was the owner, that if I did manual labor, I'm at a higher risk of getting hurt, higher than, someone that sits behind a desk. Well, once they got into that ball game, they realized that the risk factor wasn't as high that they were figuring. And so they could then open the gates a little bit and invite more people in to get the disability to really help their financial program.
And I think that I'm going to bounce this back to you, Steve, because I want your feedback on how your generation views disability and how you approach it. But I think what got missed in all of that, Sam, especially if you're business owners, business owners that I know, if they're not working or if they're disabled, they're not sitting on the couch. They're dragging themselves to work. If they're not showing up to the office, the construction site, or wherever, they're really in bad shape. So I think the insurance companies back then were missing it. I think it came back to they just didn't want the business. So they priced it so it just didn't look appealing to do it. So, Stephen, when you have these conversations with your younger financial planning clients, how much of a conversation is disability and life insurance in the totality of the plan?
Certainly a conversation. It's typically, starts with the younger clientele, and even it just kind of depends, but it routinely comes up regarding life insurance. It comes up and is relevant for most people, right? You're young now, purchase something, right? Let's get this risk transferred. And then when it comes to disability, it's the same kind of discussion. This is much more likely to happen during your working years. So we need to have a plan in place to make sure that if something does happen, that you're covered, you and your family are covered, right? And it's something I talk about, and it's a little bit of, I guess, industry knowledge. Is it's something called ONOC, which means own occupation. If you can't do your own occupation, right, you insure that risk. So if you do make, just to throw something random out there, you do make $300,000, right? And you've accumulated a certain lifestyle for you and your family. And again, what happens if you're a surgeon and you lose a hand or something like that? Well, you could still advise, you could still probably make it a decent living, but you are going to have a large gap in your income and the lifestyle that your family's grown accustomed to. So insuring that risk is often rational, and often I get a lot of buy-in. And certainly the life insurance is always part of the estate planning discussion. That's where it starts. A lot of my younger clients, I talk about it all the time, and it's harder for them to face as much as I try and twist their arms about it. Is, hey, you need to hire an estate planning attorney. You need to get a will. You need to get you need to get a guardianship figured out. You need to figure so the state doesn't appoint them, right? You need to figure out what's going to happen with your assets, so on and so forth, right? And with that, right, and with that, in conjunction with that, you should be considering life insurance, because you're putting this will in place. You're putting this, that, and the other thing in place. Well, it only matters so much if there's no money or income to be provided for those children and those family members that you leave behind. Should you go, quote unquote, before your time, but should you go young before you planned, right?
And that stems around today that most families today are dual income, and most families today seem to be equal dual income in that perspective. So it's a joint risk to a family, especially the challenge I had younger, Stephen, was people would have the conversation, but when you're younger, you still feel very durable.
Yeah.
You're not going to get disabled. The fact if you die, it's going to be because of an accident, and you don't perceive that ever happening. So the logic was there for the conversation, but the emotional, that doesn't apply to me syndrome, if you will, prevented people from, taking care of that business when it was probably the most cost-effective time for them to do it.
Right. Yeah, that's one of the things that I like to say. You don't insure what's probably going to happen. You insure what might happen, and if it does, it's financially devastating, right? You insure it, you transfer that risk, you pay a little bit of premium so you can ensure that everything's taken care of should that rare occasion, should you be one of those rare occasions.
Right.
Though life insurance kind of different is because you will die. So that's one of the only insurances that is kind of unique in that aspect. But I'll let you guys get into the technical case of when that would occur.
Right. That's always been the product that has 100% probability of paying you.
Yeah.
Right.
And one of the caveats about disability that I ran into earlier, and you probably agree with me, is that
Maybe not.
probably not.
Just to be disagreeable. But
That's
go
true.
ahead, Sammy.
Okay.
Give it your best shot.
Can I talk now? The spouse, non-working spouse, the homemaker, the domestic engineer, as we used to call him when I started in the business, the spouse that didn't work, the bread owner would say, well, what do I need insurance to cover her for? She doesn't work. She doesn't bring any income in. So why should I have insurance on my wife? And so I would say to them, well, yeah, okay, let me ask you a question. What does your wife do? Well, I mean, she cooks, she cleans. I mean, she picks the kids up. She, drives around. She does stuff for me. Okay. Well, what happens if she's not there? Who's going to do all of that? Are you going to take weeks off of vacation to take care of do the shopping, do the cleaning, run the kids around, do financial stuff, do all of that, what your wife does when she's not there? Oh, well, gee, I never thought about that.
Yeah, I always thought that was such a dangerous Neanderthal comment.
What? Domestic engineer?
Oh, no, that whole thing, that was such a level of arrogance when people thought that way.
Oh, well, yeah.
I would shake my head when I heard things like that. I'm like, oh my gosh.
You are
really?
discounting what is going on so greatly. Yeah. Yeah. Well, that's kind of the point you're making, is that spouse who's at home, right? It's gross.
Valuable.
Oh my gosh. And that's a big thing that I talk about a lot now too, is especially what I see more often, when there is like one primary breadwinner, is the secondary breadwinner is like maybe part-time. And regardless, childcare has gotten so expensive compared to how it used to be. So expensive. So because that other spouse is doing this, that, or the other thing, what's the cost? Not even what's the cost, right? Because income replacement is what people think when they think life insurance or disability insurance. Income replacement. Well, what about expense replacement, right? What is the increase in expenses going to be? And that's kind of what you're saying, because that person's not there to pull to pull the weight of the family, right? What does it cost to do that, right? And if you've already outsourced that because you're dual income, you guys both work full time, it's pretty easy. It's more income replacement, but exactly that situation, Sam, is one of the more, that's where it can get a little nuanced.
I know.
Everything that's old becomes new again, right, Sam?
It's cycle.
Yeah.
And my son lives in Upper Arlington, and they both work. She's a doctor. He's an attorney. They spend $60,000 plus on babysitting, on having a nanny to do stuff. So that's a major, that's someone's 2-family salary income coming in. And that's home. And they haven't just spent it now. They spent it almost the 10 years that they were married, because there was a need there to do that. Because a doctor can't walk away from her patient and say, oh, I got to go home. I got to take care of my kid. I got to feed him. And if you're an attorney, you just can't walk away from what you're doing and go home and go pick up your kid at school because they're sick. So that's a void where you have to fill. You got to do what you have to do to take care of your family and the kids. So again, that's an expense that, people have to think of. Oh, well, yeah, we can afford it. Okay, well, what happens if one of you becomes disabled? Are then you going to be able to afford it?
Mm-hmm. And this goes back to what the comment you made and the comment you made, Stephen and Sam, that back in the day, the guy that would sit there and say, I'm the breadwinner, what's her value? Today, because of the cost to raise children, if a family chooses to have one of the spouses be the stay-home parent, and I see it as much with men being the stay-home parent as women, so that's why you use it in that context, that they're choosing that because the cost for both of them to work, and we've had this conversation with clients a lot, saying, by the time I pay everything to go to work, there really isn't that much left. And the chaos that this is creating, we're better to tighten our belt a little bit and live on the one income and raise our children. So we're seeing some returns to that maybe more traditional way of families being raised, because, to Stephen, to your point, because the cost for two people to work today and take care of children, to your point, Sam, has become quite expensive.
Well, there's more kids that I know that are being homeschooled.
True.
By their parents, usually the mother. But, years ago, nobody did it.
Right. Mm-hmm. Well, if I homeschooled my kids, I could tell you they would be much more proficient in their vulgarity.
Oh, yes.
I think we figured that out pretty easily, and I'll spare your listeners from that.
Yeah.
I think we did figure that out.
I think they picked up pretty good on that. Just from what I know of the last 15 years.
Yeah. All right, I got to take a break, but when I come back, I want to present you guys with some different scenarios, because what I want to do is say, okay, practically, what's the best product in this, not company, best strategy, not even product, best strategy in a couple of different scenarios. So we can walk through some listeners that are in specific scenarios, give them some tools on what it is they should be researching. So if somebody's talking to them about insurance needs, they have a better handle on it. So I'll be back after this break. I have Sam Morocco and Stephen Daprile, and this is our second in a series on practical uses of insurance. This is Leo Daprile. This is the Gem Young Wealthcast. We'll be back after this break.
Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Here we are in our second in a series of more practical, sensible ways to buy and own your insurance. I have with me Stephen Daprile and Sam Morocco. Two of my favorites. Last week I had three other of my favorites, and even though I say you guys are all my favorites, who's in the studio with me at the time is my current favorite. So you two are currently my favorites today. So
Yeah, I'll take it.
Okay.
I'll take it.
And like I tell my staff all the time, I say sucking up is an excellent career move. So if a little cash or a candy bar ended up on my desk, I'd be greatly appreciative of that. Just letting you know now. Okay. Mm-hmm. So we're talking a little bit about life insurance and disability and trying to give you some practical scenarios of where people are viewing it today. The industry itself has evolved. The product, the chassis of the products is essentially the same as it's been for 30, 40 years. But the way they go about executing how they are going to pay you interest rate and using different indexes, as an example, to try to boost returns in a low interest rate environment, adds another level of complexity to the product. More complexity to the funding. And then we also have term insurance, which has, again, been around for a long time. So the question we always get asked is, which one is the best for me? And if you're a regular listener, then you know I'll say things like there is no perfect product for anybody. Sometimes it's one product over the other. Sometimes it's a combination of the products that, because at the end of the day, tongue in cheek, but I was joking but serious with clients, is whether you owned a term insurance or a whole life insurance, when you passed away, you cared about the money, right? Because the check cashed the same regardless of the product that you bought. The difference had to do with maybe features, benefits, the longevity of how long you thought you might need it. So that's why I've always said it's neither good nor neither bad, and there's no good or bad products in the industry. It's what serves you best. So, Sam, I'll start with you. Let me give you a scenario. You have a husband and wife who have been aspiring to a work optional lifestyle, and let's say that they're 60. And let's say they plan on working till 60, I'll make it 62, okay? They've saved effectively enough. They're going to have the income that they want, but their threats to their work optional lifestyle would be an extended nursing home stay. So in terms of, I'll call it a pure life insurance conversation, they really don't need life insurance. They have enough cash. But between both their 401ks and their Social Security, an extended nursing home stay could really hurt the other. How do they solve that problem? What are some of their, again, keep it strategic, not about company.
Right.
And give me some thoughts, generally speaking, of what they need to think about to address that.
Well, first thing I would do if I was talking to them, I would investigate the amount of assets that they had, volume-wise. In other words, 200,000, 300,000, 1 million, 2 million, okay, and what kind of assets they were. Retirement or non-retirement. And then I'd look at their health situation and see if they would be healthy enough to pass a life insurance exam. If all of that was proper, then I would get a life insurance policy on them with a long-term care rider. The amount of death benefit would be in proportion with what we would determine the gap to pay for that nursing home would be. Not the entire amount, but the gap, because as we well know, if they're dual income, they got incomes coming in at retirement. So if one needed care, where's that income going to go? That income's going to go to the nursing home also. So the gap would be what they could get from their life insurance policy. So that's how I would pick the death benefit. So for an example, a $500,000 life insurance policy at a 4% long-term care rider will give them $20,000 a month. Well, that may be enough to pay for their long-term care, but it may not be affordable for them. So we might look at a 2% rider or a $250,000 life insurance policy with a 4% long-term care rider to give them $10,000. That might be sufficient because they have a couple thousand or two in income to put that together to pay for their long-term care. So we do that. Well, let's go down another road. So they're not healthy enough to qualify for life insurance. So then we would look at the hybrid type of long-term care, that it would be hybrid. We have, life insurance and long-term care insurance, and sometimes an annuity all thrown into one. And that would provide a benefit for them. And we could do that together. In other words, underwrite both of them together, put them on one policy, or do individual, depending upon their age, depending upon their health. So there's a number of different ways. We would never, ever tell them to go out and buy long-term care insurance. That's much more too expensive. And if you don't use it, you lose all of it. So we would not, that's not in play. It used to be years ago when I first started selling it, it was a great thing to do. But the cost of things went up, longevity went up, people are living longer, the medical costs are going through the roof, but also technology is growing in the sense that they could do things medically to prolong life today that they never did 20 years ago. In fact, 15 years ago. So all of that, put that together, what comes out is that you have people living longer. You have people going into care. And if something happens to them at a younger age, they're going to go into that care quicker. So you need to address that maybe earlier than, I'm going to retire next year. Do it 3, 4, 5 years before you want to retire, even 10 years before. Look at what's going on. And then do that in as far as your life insurance and filing for long-term care.
So, Steve, this is important because here's where I've evolved. And I'm going to ask you the same question for younger people and where they plug in the types of, permanent insurance versus term insurance. But here's where the financial planning's evolved. And this is what I want people to think about too. 10 years ago, you may have looked at, for instance, long-term care as a solution and said, nah, I don't want to pay the premium because I don't get anything back, which was the common objection to why people didn't buy long-term care. Here's the dilemma that as I move along in this stage of my career and having done this for as long as I have, is back in the day, everybody said, my kids will take care of me, and to a large degree they did. But Sam, to your point, with such an increase in longevity, you're asking kids that are maybe retired by the time you're in that scenario, and they physically can't, as much as they may want to. So we're finding the utilization of parents going into a nursing home rising, but it wasn't for reasons I thought.
Well, geographical too. My mother-in-law just passed away last year, but she had to go get care. She was in Florida, West Palm Beach. Her daughter is here with me in Ohio. Her son lives in Scranton. So who's going to go take care of her if she needed to do? Leave your families and go to West Palm Beach and take care. Well, my wife did, but eventually we moved her back up here. But sometimes you can't do that. So it was a problem to consider, to think about. We never thought about it until it happened.
Right. And this is why I want, and Steve, the terms we used to use 20 years ago that we don't use anymore. We used to call it the sandwich generation, where people were sandwiched between taking care of their parents and taking care of their kids. That term doesn't get used anymore because, can I use you for an example?
Sure.
You're having to take care of an aging mother-in-law, but you're also surrounded by grandkids. So you're really not a sandwich generation. You are already another generation down. So in the way your family unit's structured and where your grandkids are, mostly, thank God, around here for you to enjoy. But a lot of people, their grandkids are around the country. So they really, and many times we've seen clients move to help be the caregiver for their grandkids, which kind of takes them out of that. So this problem kind of was, it was of high interest, not a lot of people doing anything about it, to now, and then sprinkling the cost. And you've heard me, listeners have heard me talk about that. I've had a recent experience with a family member going into a nursing home scenario, and the cost was eye-popping to me, absolutely eye-popping to me. So all of a sudden, that's when my financial planner hat goes on and goes, holy smokes, this problem just exploded in 3 to 5 years. This problem went from a manageable, based on your net worth, handling the solution, to a lot of people may not be able to anymore. So that's why we're bringing these sorts of conversations back up, because the risk profile in the longevity landscape has changed tremendously. And Steve, when you talk to your younger clients and their parents are aging, back in the day, the conversation from when I was in your scenario, people wanted to talk about long-term care or life insurance because what their parents didn't do, and what they were going to be saddled with. How do those conversations go for you guys?
Regarding long-term care discussions at this age?
That in life insurance.
Yeah. Long-term care discussions are unique because I think you have to first identify a need for permanent insurance. And also the discussion's different if you're 25 versus 45, right? But in my opinion, more often than not, to be staring down the barrel of permanent insurance at a younger age, and in this case, I'm using, let's say, 20s, early 30s. You really need to be doing everything right from a savings perspective before I would consider it. Because the reality is, as great as life insurance is, it's not an investment vehicle, right? And more often than not, growing your assets at the best clip you can is the best way to hedge risks, namely long-term care, right? Which inflates at an astronomical rate, but your money's still probably better off in the market than in an insurance policy to hedge a risk that you might have 50, 60 years from now. I don't think more often than not, it doesn't make sense to start considering that unless a permanent policy makes sense, which, again, if a permanent policy makes sense, you have to be checking a certain amount of boxes. And that's more specifically for younger clientele. The older you get, the more that discussion changes, right? The older you get, if you haven't accumulated those assets and you haven't been checking those boxes, you might have to start considering a more permanent philosophy, right? You might have to start considering that as a legitimate risk to your financial plan. But if you're younger and you're doing things like maxing out your 401k and things like that, and it's very variable. It's not something it's something I'm aware of in design for people where permanent insurance fits, but it's not something that I'm going to hedge the risk on for somebody who can barely afford to make their life insurance term payments, right? Or who can make it, but it only so much, or they had to give way here, right? You can go with a diversified strategy where it's not an either or situation. But again, I think to even go with, part term, part permanent, if you're looking at something like that, it makes sense to consider it in there, right? But even in that situation, I think you need to be checking certain boxes to meet that criteria at the younger age, because you have decades of market to play in your favor, right? And because of that, the compounded interest rate of the growth of your assets is a better tool in your toolbox than an insurance product to hedge the long-term care risk. And I'm talking about long-term care pretty much exclusively here, right? So I think that's why it's important to align yourself with, I think, somebody who's holistic, like the three of us are when you're considering these types of discussions, right? Because we're not just thinking about we're not trained really to just look at the risk and how we can solve and mitigate that risk. We're looking at what we call the opportunity cost of that risk, right? So those X amount of dollars that you put in there today, well, those dollars are going to be worth a heck of a lot more in the market than they would in a policy. So that's how we have to, that's the unique part about doing life insurance and mitigating these risks for younger clients, right? Oftentimes you're dealing with what's right in front of you because money's tighter when you're younger, right?
I 100% agree with you. One caveat, though, that the insurance companies are doing that's going to help you in your scenario with term insurance is that a lot of companies are adding a long-term care rider to their term insurance policies. It's accelerated death benefit rider that they would call, or a critical illness rider. And that sometimes is a free part of the policy, added to it. So those companies, have come out and said, I mean, if I take a permanent policy and I put a 4% long-term care rider on it, I'm paying 4% of the death benefit. Well, why can't I do that with term insurance? It's the same thing. I'm liquidating the life insurance amount, not any cash value. So in that regard, it helps you as a planner for those young people. I mean, if they're not married and if they don't have any kids, I mean, there's a lot of factors that come into it. But the fact of the matter that the insurance companies are stepping up and saying, well, hey, why can't I add this benefit? It makes them more attractive for the people to use their product.
Yeah, and that's what it gets down to, the specific nature of each client and their wants and needs. Take that a step further. I've had clients that were well on their way to their work optional lifestyle, but not quite there, that maybe needed another 5 or 7 work years to get there where they would have enough capital that they wouldn't need these other things. In those situations, we would do like a 10-year term because they didn't really need permanent. They just needed to finish creating that estate that they haven't been around to create in case they're not here. So that's just another example of where it's very person-specific, situation-specific, and not one product better than another.
We, fortunately here, and the way we do things at Gem Young, we have the availability to match whatever availability product or solution there is in the industry to meet the needs of the clients that come in here, whether they're 4 or 5 years away for the work optional lifestyle, whether they're 1 year, whether they're in their work optional lifestyle and need something. We have the availability resources to be able to match something that's in the industry that will solve their problem moving forward. So I really do think we're kind of ahead of the market in that area.
And the insurance companies that play in this space has also changed dramatically, through the years. And then the product pricing, how it's come out, it's changed, because especially as people live longer, new mortality tables come out. So since people are living longer, insurance companies have more years to spread out the risk. So newer policies, I hate to use this term, look like they're cheaper. They're not. Insurance company just has the opportunity to get their required premium back over a longer period of time. But it's also something, if you have a really old product, and, I just did this with a client, sometimes these really old life insurance policies are good stuff, Some of them have been around long enough that they pay phenomenal dividends. They're worth some aren't. It's the other side of the coin. That's why we look at them all the time. I looked at one for a client a couple weeks ago and asked me what I should do, what he thought I should do with that. I went, I think it's doing great. It's an old policy, and again, premium wasn't much. The dividend exceeded the premium he was getting every year, so it really wasn't costing anything anymore. But he chose cashing it.
He wanted that Mustang.
Well, they looked at everything else in the plan, and I said, what? He goes, I think I'm okay. I think I want the cash.
Yeah.
I said, okay. Well, but that's what we do here. I gave him the information and the data, and said, here's what you got, and here's my opinion, my professional opinion on it. And he said, chose from there. So, but that's what a true work optional lifestyle should be. That's what a true financial plan should be, giving people these choices, right? That's what work optional is all about, choice. So making sure that you can get there once you get to that stage and be able to see your way all the way through it, in case things happen. like the long-term care, and it's not the other thing too about long-term care that's also become a big game is home health care before you get there, or assisted living before you get there. None of that stuff's cheap. Again, having had this experience in the last 4 or 5 months, it's eye-popping stuff at all this cost. So, I'm looking harder at plans than I was before, saying, okay, maybe it's time to revisit some of this stuff.
And the medical insurance that some people figure will cover it when they get to be 65, like Medicare, doesn't. And they have specific rules that say, gee, we will cover home health care if you spend 3 days in a hospital, go directly from the hospital to your home, and are homebound, meaning you can't go in the front porch or the back porch. You have to be homebound inside. Then we will pay for it.
Yeah, it's just getting to be that way. So all right. Hey, Stevie, any final thoughts on this? One of the things you could advise listeners on what they should be looking for, do's and don'ts that you see flaws when you talk to people?
Yeah, I think certainly just since I'm, I guess, speaking to the more younger crowd is do your estate planning homework, right? And think through what happens should you go, right? Financially speaking. And obviously get your affairs in order so your family's taken care of. Part of that is life insurance.
Recognize your mortality, come to terms with it, and do something about it.
Yeah, I kind of like the way you said it better. Can I just use that?
That's the old guy in the room. That's how we say it.
I like
to
the
you
way you
guys.
said it better.
Yeah. All right, Sam, about out of time. Anything you want to add real quick?
Just one thing, Leo. Over my career, especially the last 15 years, I just will advise or tell people, get help, get advice. Pick the phone and call someone that knows a little bit more than you do. There's nothing wrong with saying, I want to check to make sure I'm okay. And I think that's where our resources can help. Give us a call and let us sit down and have a conversation. Okay. It doesn't cost anything to talk.
That's right. Doesn't cost anything to talk. All right, boys, I am out of time. Thank you both for joining me today. Great stuff, a lot of good information. So, okay, this is Leo Daprile. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. I always appreciate when Sam and Steven come on the show and give you a different perspective. I like these two together because Sam is going to give you a long, storied career in insurance and all the different approaches that he's learned and experienced through his career. And Stephen coming from the technical CFP route. So to have both professionals like that in a room is going to give you much more depth to the conversation. Hopefully you got that today. I've sprinkled in some of my own life experiences within both of these industries and how this plays out in real time. Again, that's the whole purpose of these shows this month, is to give you more of a rubber meets the road uses of your insurance and where the practical reasons to own it, so that you don't have to worry about being emotional what you do. You can have a program that fits you or decide what it is that you want and don't want, which sometimes is the key, figuring out what you want and don't want. Like everything in insurance, the reason I like to talk about these as much as money is it's got its own language, it's got its own terms, and figuring out what all of this is and then seeing how it applies to you in the real world is what our goal is. So, and you can see collaboratively that each one has a different specialty. Sam's back in school, wanting to become registered in his Social Security analyst, which we're finding to be a greater and greater need for our clients. So stay tuned for when he finishes that. Again, that's an important need that every one of our clients asks us about. Is there's a myriad of Social Security questions that, even though we're financial planners, without having an area of expertise, we're just not well-versed enough in the nuance, but we will be shortly. So we'll be bringing that to the table too. So stay tuned. I'll have Sam on for a special episode for that, so you can hear exactly what that's about and how all of that fits. So again, I appreciate Stephen coming on and giving perspective, generational perspective, Sam giving generational perspective on where products were, where buying behaviors were, where buying behaviors are today, realistic advice on disability insurance if you haven't really considered it. Hopefully we made the case for you to consider it. So it was a great show. I hope you got a lot out of it, and I do appreciate you listening. This is Leo Daprile. This is the Gem Young Wealthcast, and until next time.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.